I want to settle this once and for all. Real estate versus stocks. It is the single most argued topic in personal finance. You've heard it from your parents, your coworkers, your cousin who just bought a rental property, the guy at the party who won't stop talking about his index funds. Everybody has an opinion. Almost nobody has actually run the math. And I mean the real math, not the version that cherry-picks a hot real estate market to make housing look unbeatable, and not the version that uses peak S&P 500 returns to make stocks look like a no-brainer. The honest, uncomfortable, apples-to-apples comparison that accounts for what most people conveniently leave out of the calculation. Because here's what I've noticed. People don't argue about real estate versus stocks because one is clearly better. They argue about it because both sides are hiding something. And once you see what each side isn't telling you, the answer becomes a lot clearer and a lot more personal than any YouTube comment section will ever admit. By the end of this video, you'll have the actual numbers, the actual comparison, and a framework for deciding which one makes more sense for your specific situation. Let's do the math. Quick one, if you're new here, I make videos that cut through the noise on money topics that usually generate more arguments than answers. Subscribe if that's useful. New video every day. Alright, let's actually look at the numbers. To make this comparison honest, we need the same starting money, the same time period, and the same person making the decision. So here's our scenario. You have $60,000 saved. It's 2004. You're 30 years old. You make a decision, real estate or stocks, and you stick with it for exactly 20 years until 2024. We're going to see what each path actually produced. Path A, real estate. You use the $60,000 as a 20% down payment on a $300,000 home. You rent it out. You hold it for 20 years. We'll use national average appreciation and rental income data. Path B, stocks. You invest the same $60,000 into an S&P 500 index fund. You never touch it. You reinvest dividends you hold for 20 years. We use the actual historical returns. Simple setup, same money, same time, same discipline. Let's see what the math actually says and where each side cheats to make their case look stronger than it is. The real estate argument usually goes like this. You bought a $300,000 house, it's now worth $600,000, you doubled your money. Real estate wins. That math is not wrong, it's just catastrophically incomplete. Now subtract those costs from your $300,000 gain. Your actual net profit from the real estate path, after expenses, after the mortgage interest, after everything, is roughly $82,000 to $120,000, depending on your specific market and vacancy rate. But wait, you also collected rent. At $1,800 per month average rent over 20 years, that's $432,000 in gross rental income. After expenses, taxes on that income, and management costs, net rental income is realistically around $140,000 to $180,000 over the period. So the real estate total, appreciation profit plus net rental income, comes to roughly $220,000 to $300,000 in real, spendable wealth created from your original $60,000. And that's actually pretty good. But now let's look at what stocks did with the same money during the same period, because this is where people on the real estate side go very quiet. $60,000 invested in an S&P 500 index fund in January 2004, dividends reinvested, completely untouched for 20 years, same $60,000. No midnight calls about a broken water heater, no property manager fees, no vacancy months, no roof replacement. Just $60,000 sitting in a Vanguard account earning the market return for 20 years. Now the stock side has its own things it conveniently leaves out. The S&P 500 dropped 57% between 2007 and 2009. It dropped 34% in 5 weeks in early 2020. If you panicked and sold during either of those periods, your $430,000 outcome doesn't exist, you locked in a catastrophic loss instead. Stocks also have no leverage built in. Your $60,000 in stocks controls $60,000 of assets. Your $60,000 down payment controlled a $300,000 property, and you captured appreciation on the full $300,000, not just your $60,000. That leverage is real and it matters, especially in markets that appreciated faster than the national average. So the honest scoreboard after 20 years, stocks, $430,000, $480,000. Real estate, In net wealth created but with rental income cash flow the stocks didn't provide and with a tangible asset you can see and touch. Here's where I'm going to lose the comments section because neither side wants to hear this. The real estate versus stocks debate assumes you're choosing between two investment strategies, but that's not actually what most Americans are doing when they buy a home. When someone buys a house to live in, it is not an investment in any meaningful financial sense. It's a consumption decision with an asset attached. You're buying a place to exist. You're paying for stability, community, schools, a neighborhood. The financial return is secondary and in many cases negative once you run the full cost calculation. The average American homeowner's primary residence over the last 100 years has appreciated at roughly 1.1% above inflation annually after costs. That's not an investment return, that's barely inflation protection. Robert Shiller, the Nobel Prize-winning economist who literally built the index that tracks U.S. home prices, has been saying this for 20 years. His own data shows that homes as investments barely keep pace with inflation when you account for all carrying costs. The wealth creation story in real estate comes from rental properties, not primary residences. So the debate most people are actually having, should I buy a house or invest in stocks, is not the same as real estate versus stocks. Buying a home to live in is a lifestyle decision. Buying a rental property is a business decision. Investing in stocks is a wealth-building decision. These are three different things that people collapse into one debate and then argue about forever without ever getting anywhere. The people who actually build the most wealth, they don't choose. They buy a modest primary residence, not the most house they can afford, a reasonable house they can afford easily, and invest the difference in index funds. The leverage of real estate plus the liquidity and return of equities without overcommitting to either. So which one is right for you? Here's the actual framework. Real estate wins if you're in a below-average cost market where rent-to-price ratios make cash flow realistic. You're willing to operate it as an actual business, tenant management, maintenance, vacancies. You have the down payment without draining your emergency fund or retirement accounts. And you're staying in the area long enough for appreciation to overcome transaction costs, minimum 5-7 years. Stocks win if you're in a high-cost market where rental cash flow is nearly impossible. You want liquidity, the ability to access your money without a 45-day closing process. You don't want to be a landlord or manage a property. You're in the early stages of building wealth and need flexibility. And you can emotionally handle market drops without selling. The math shows stocks have historically outperformed real estate on a pure return basis when you run the full cost accounting. But real estate offers something stocks don't. Forced savings through mortgage paydown, leverage that magnifies gains in appreciating markets, and income that doesn't depend on market performance. The right answer is almost never only one of these. The right answer is which one first and how much of each. Given where I actually am right now, here's what I want you to do after this video. One question, take your time with it. Look at the market you live in right now and find the price-to-rent ratio. Take the median home price in your area, divide it by the annual rent for a comparable property. If that number is above 20, rental real estate in your market is extremely hard to cash flow. Stocks are almost certainly the better pure financial move. If it's below 15, rental real estate in your market starts to make serious mathematical sense. Most people have never run this number. It takes 5 minutes. And it immediately cuts through about 90% of the real estate versus stocks debate for your specific situation, which is the only situation that actually matters. Alright, drop a comment. Real estate or stocks? And if you changed your mind somewhere in this video, tell me where. That's genuinely the most useful comment you can leave. If this gave you a more honest way to think about the decision, subscribe. One real money video every day, no sides taken. Next week, how your brain is actually wired to keep spending money even when you're actively trying to stop, and the one mental shift that works better than any budgeting app. See you there.